हेलो फ्रेंड्स, वेलकम टू माय चैनल। दिस इज सीए राखी अग्रवाल। आज का हमारा टॉपिक है इंडियन अकाउंटिंग स्टैंडर्ड 101 which talks about the first time adoption of India. This topic is discussed in two parts. That is part 1. Today I am going to discuss. In part 1 we are going to discuss about some of the important definition of these standard. Then we are going to discuss about the general accounting principles of India. Then we are going to discuss about the accounting policies. Then we are going to discuss about the optional exemption. Then we are going to discuss about mandatory exceptions and practical case studies. So these are the content of these standard which we are going to discuss. In today's session, we are going to discuss some important definitions, general principles of Indian accounting standard, accounting policies, and optional exemption. Optional exemption partly we will discuss in this session, and partly we will discuss in the next session. And in next session we complete our standard. So in the next session we will discuss about the mandatory exception practical with some practical case studies. So let's start our talk. Firstly, we will discuss about the entity who adopt index for the first time. Which entity adopt index for the first time? Generally, Indian companies whose net worth as per phase 1 criteria exceed 500 crores and who are listed companies on which index in phase 2 criteria, if they fulfill, then the net worth becomes 250 crores, and even the company is not listed index. So index is applicable on the entities whose net worth crosses 250 crores and who are listed companies who are NBFC companies. Index is not applicable on the banking companies, insurance companies, one person companies, small companies, and also not on individual even if their net worth exceed 500 crores. So India has become mandatory for the entity whose net worth crosses 250 crores. In our example, suppose we are going to discuss this first time adoption explanation with the help of example. Suppose on 31st March 2023, net worth of an entity becomes 150 crores. But on 31st March 24, it becomes 260 crores. So it exceeds 250 crores. So it has become mandatory for the entity for the financial year 31st March 23 to 31st March 24. So it becomes mandatory for the entity whose net worth exceeds 250 crores in that year. Index is applicable on that company. It become mandatory for that entity to apply index. So for the first time, if they are preparing their financials by adopting index, they are required to prepare 3 balance sheets. For which period and what is the transition period for that? For the in the year when the index is applicable, that is on 31st March 24, when the net worth exceed 250 crores. In that year, that is the current year financial, that is the final balance sheets, and previous 2 years, like in previous year, that is the comparative figures, adjusted comparative figures from Indian GAAP to Index, that is on 31st March 2023, and on 1st April 22, that is they are required to prepare opening balance sheet. On 1st April 2022, that is the transition period when the entity transit its carrying value from Indian GAAP to Index. And on 31st March 23, they are required to prepare the comparative figures, that is adjusted comparative figures from Indian GAAP to Index, because previously they are preparing their balance sheet as per IGAP, but now when the Index is applicable, so they are going to prepare 3 balance sheets, the current year balance sheet, then last 2 previous years, comparative figures and the opening balance sheet. So these are the concepts when the first time entity adopt. So they are required to prepare 3 balance sheets. First is opening balance sheet, then comparative balance sheet, and the final balance sheet. What is the transition period? Transition period is the opening balance sheet when the entity is required to prepare. That is on 1st April 2022 is the transition period where just like they are going to prepare balance sheet, profit and loss statement, statement of change in equity, then they are going to prepare cash flows, adjusted cash flows. Balance sheet is prepared for the 3 years, that is on 1st April 2022, 31st March 2023 and 31st March 2024. That is the current final balance sheet, comparative balance sheet and opening balance sheet. Profit and loss statement is prepared for 2 years. It is the final and the previous comparative figures. There is no required to prepare opening profit and loss account, because opening profit and loss account is not required, because the profit and loss is the actual cost, actual expenses. It is not carrying their expenses in every year. So opening carrying value is not required for profit and loss account. Only the current income and expenses and the comparative figures is required. Statement of change in equity. 3 years of statement of change in equity is required to be prepared. Cash flow only 2 years, that is the current, final and the comparative years. OCI only for the 2 years, that is the current and comparative. No required to prepare OCI for the opening. Now, because balance sheet items notes are required to prepare for the 3 years, but PL notes are required to prepare only for the 2 years. That is the final years and the comparative figures. Other disclosures is required to be disclosed for the 3 years, and reconciliation is required to prepare for equity reconciliation, because equity reconciliation is required to prepare from for opening and for the comparative years, because equity is a carry forward items, so it is required to carry forward from the previous year. It is not required to prepare. Reconciliation is not required for the final balance sheet, but for the comparative figures and opening figures, equity reconciliation is required. PL reconciliation is not required for opening, and also for the current. PL reconciliation is only for the comparative figures. Accounting policies is required to disclose for all the 3 years, for the opening, for the comparative figures and for the final. Now, some important definition related to applicability of Ind AS 101. What are the important definitions? Like transition date. What is transition date? When it is applicable? To which company it is applicable? The standard 101 is applicable only on transition date when the company adopt Ind AS for the first time. That is on, in our example, 1st April 2022 is the transition date when the company adopt Ind AS for the first time. First time adopter means if an entity which prepare its financials for the first time as per Ind AS. So, first time adopter is an entity who prepares its balance sheet or its financial statement for the first time as per Ind AS. Entity means company, whether listed or not, whose net worth crosses 250 crores, and NBFC companies are the entities on which Ind AS will apply. First Ind AS financial statement means the statement which is prepared by the entity by adopting Ind AS for the first time with an explicit and unreserved statement. For the first Ind AS financial statement, an entity is required to give an explicit and unreserved statement. What do you mean by explicit and unreserved statement? Explicit and unreserved statement means if an entity complies all Ind AS, if an entity comply all the Ind AS but does not mention explicit or unreserved statement of compliances in its financial statement, then such financial statements are not considered in compliances of Ind AS. Means if an entity comply all the Ind AS as per accounting standards, apply all the Ind AS, but they will not mention explicit and unreserved statement, even they are applying all the Ind AS, then in such cases that financial statement are not complied, as per Ind AS. But if an entity mention the explicit and unreserved statement of compliances in the financial statement, even the auditor will disagree with the compliances, even then in that case also it will be treated that the financial statement are in complied with Ind AS. If an entity mention its explicit and unreserved statement of compliances in the financial statement and there is a disagreement with the auditor in respect of any accounting standard application, even then also in such cases also financial statement shall be considered as in compliances with Ind AS. So if they are not mentioning unreserved and explicit statement, then it will be not complied with Ind AS. But if it is mentioned that the financials are prepared as per explicit and unreserved statement, then it will be treated as complied financial statement as per Ind AS, even if the auditor disagree with the application of. What do you mean by the previous gap? Previous gap means Indian gap before application of Ind AS. Previous gap means whatever the gap adopted by the entity before adaptation of Ind AS, Indian Accounting Standard. It may be IFRS, Indian gap. So previous gap means any gap before adoption of Ind AS. But as per Indian Accounting Standard, as per the definition of previous gap, is the basis of accounting used by the entity for the purpose of statutory reporting requirement in India. Because previous gap means any gap adopted by an entity before application of Ind AS. But as per these definition, as per Indian Accounting Standard definition, previous gap is the basis of accounting used by the entity for the purpose of statutory reporting requirement in. Statutory reporting requirement means Ministry of Corporate Affairs who prepare these accounting standards as per section 133 of the Companies Act 2013. So such financial statement must be prepared as per section 133 of the Companies Act 2013 as amended from time to time basis. So statutory reporting requirement in India means a statute who has the power to issue accounting standard in consultation with ICI. Who are they? They are the MCA, Ministry of Corporate Affairs, who has the power to issue accounting standard. MCA has issued two accounting standards, that is Indian GAAP and another one is Indian Accounting Standards. They had issued before application of Ind AS, that is the Indian GAAP. So Indian GAAP is the previous GAAP in our definition. So statutory reporting requirement in India words have been intentionally added in the definition of previous gap, because if these words are not added, then anyone can adopt any standards as previous gap, that like they adopt IFRS, they can means they will use any standards as previous gap. So these statutory reporting requirement in India is intentionally added in the definition of previous gap because these words is not available in the definition of IFRS previous gap. So this is a carving from IFRS, because in IFRS previous gap definition, these statutory reporting requirement in India is not mentioned. Now this concept of statutory reporting requirement is explained with the help of example. When on the first time Ind AS is implemented in India in 2016-17, then the company whose net worth having 500 crores or more and the companies who is listed in India should apply Ind AS. So when for the first time when Ind AS is implemented in India, the companies whose net worth crosses 500 crores and the company who are listed in India are required to prepare its financials as per Ind AS. Now SEBI issued circular in 2010, but SEBI is not a statute that time. SEBI is a regulator. So SEBI issued a circular in 2010 that any Indian company who has multiple subsidiaries located outside India and preparing its balance sheets in IFRS. The SEBI issue a circular that the companies whose has a multiple subsidiaries who is located outside India has to prepare its financials as per IFRS. They are free to prepare its balance sheet as per IFRS. They are not required to prepare as per IGAAP. Only Indian company are required to prepare. Subsidiaries if located outside India, they apply IFRS. Continue to prepare its CFS in IFRS only. For example, Bharti Airtel has adopted IFRS to prepare its CFS. So Bharti adopted also IFRS to prepare its consolidated financial statement. Because SEBI has issued circular and given an exemption that the subsidiaries who are located outside India shall prepare its financials as per IFRS, and consolidated financial statement is also prepared as per IFRS. But when Ind AS applicable on 2017 in all the phase 1 companies, then at that time Bharti Airtel converted financials from IFRS to Indian GAAP because they are not going to convert directly from IFRS to Ind AS, because as per the definition of previous gaps are those gaps which are prepared as per statutory reporting requirement in India, and statutory reporting requirement in India means the statute who issue accounting standard as per section 133 of the Companies Act. Because as per the definition of previous gap, accounting standard used by the entity to prepare its financials is as per the statutory reporting requirement in India, and the statutory reporting requirement means as per the statute. And SEBI, who issues circular to prepare CFS as per IFRS, is not a statute. They act as a regulator, so they are not statute. The statutory reporting requirement means MCA, who has the power to issue accounting standard in consultation with ICI under section 133 of the Companies Act 2013. Now, definition of transition date. Transition date means the date on which the entity transit its all its balance sheets from Indian GAAP to Ind AS. That is, the opening of comparative period will be the transition date. This is to be explained with the help of example. Suppose on 31st March 2023, first time Ind AS apply, that is the current year prepared as per Ind AS. Then comparative period will be 31st March 2022, that is comparative period adjusted as per Ind AS, and on 1st April 2021, that is the opening of comparative period prepared as per Ind AS, is the date of transition from Indian GAAP to Ind AS. So 1st April 2021 is the transition date in our exam. Now illustration 1, company Y Limited is a foreign subsidiary of X Limited. So company Y is a subsidiary, foreign subsidiary of X Limited. X Limited is an Indian company and Y Limited is a foreign subsidiary of X Limited. Y Limited adopted IFRS to prepare its financial statement. Because it's a foreign company, they are adopting to prepare its financials as per the Y Limited is required to present its financials to X Limited. So they are also preparing its financials as per section 133 of the Companies Act, that is as per IGAAP, Indian GAAP, for consolidation purpose. Now company Y use IFRS as primary GAAP and Indian GAAP as per section 133 of the Companies Act as a secondary GAAP. Because their company Y is located in foreign, so primary GAAP of that company is the IFRS and secondary GAAP is the Indian GAAP. because this statement is prepared by a entity Y for the consolidation purpose. Now X Limited transited financials from IGAAP to Indian Accounting Standard (IND-AS) and prepared standalone financials and consolidated financial statement as per IND-AS. So X Limited, which is a holding company, which is an Indian company, required to prepare its financials transited financials from Indian GAAP to IND-AS and prepare its standalone financials and also consolidated financials as per IND-AS. Now the question is, in which financial statement of Y Limited is used by X Limited for consolidation as per the definition of previous GAAP? So which financials is used by, because I had already discussed Y Limited is preparing two financials, that is as per IFRS and as per Indian GAAP. These financials are prepared by Y Limited for consolidation purpose, and as per the definition of previous GAAP also, it is said that previous GAAP is the basis of accounting used by the entity for the purpose of statutory reporting requirement in India before adoption of IND-AS. So in our case, as per section 133 of the Companies Act, that is the Indian GAAP specified by the statute. So in our case, yes, section 133 of the Companies Act, financials prepared by Y Limited is used for consolidation purpose by X Limited. Now illustration 2. Suppose E Limited. E Limited is required for the first adoption in India. E Limited is required to first time adopt Indian accounting standard from 1st April 21. The management of E Limited has prepared its financials in accordance with IND-AS and as explicit and unreserved statement of compliances with IND-AS has been given by the management. However, there is a disagreement on application of one of the IND-AS between the management and auditor. Can such financial statement of E Limited will be treated as first IND-AS financial statement? Yes, it will be treated as first financial statement even if the auditor will disagree. So background of the transaction means the management of E Limited has prepared its financials in accordance with IND-AS and an explicit and unreserved statement of compliances with IND-AS has been given by the management. But there is a disagreement on application of one IND-AS. Only one IND-AS, there is a disagreement between the management and auditor. What was the technical guidance as per the standard? IND-AS 101 defines first IND-AS financial statement as the first annual financial statement in which an entity adopt Indian accounting standard by an explicit and unreserved statement in compliances with IND-AS. Analysis. In accordance with the above definition, if an explicit and unreserved statement of compliances with IND-AS has been given in the financial statement, even if auditor report contain a qualification because of the disagreement on application of any one standard, Indian accounting standard, it would be considered that the entity E Limited has complied the first time adoption of IND-AS. In such case, exemption given under IND-AS 101 cannot be availed again. So, however, the unreserved statement of compliances with IND-AS is not given in the financials. If it is not given, then in such case the financial statement would not be considered to be the first time IND-AS financial statement. So conclusion, as per the above analysis and technical guidelines, the company E Limited has complied the first time adoption of IND. Now we are going to discuss the accounting policies. There are some of the policies which are going to discuss because policy must be consistent. They has to follow consistent accounting policies when the entity prepared its financials for the first time for all the period. Because if they were not consistent in disclosing their policies, it would not be considered that they are preparing their balance sheets as per IND-AS. So suppose company follow FIFO method for valuation of inventory before adoption of IND-AS. Company adopt as on 31st March 2023 and value its inventory using weighted average method. Whether the entity follow guidance as per Ind AS 101. Ind AS 101 gives a guidance that the policy must be disclosed in the financials, must be consistent. So in our example, they are not following the guidance available in the standard because they are following before adaptation of Ind AS FIFO method, but after adapting Ind AS they are following weighted average. So they are not following the consistent method of application, because for comparative years they are following FIFO method, but when the Ind AS is finally applicable in the year, they are following weighted average. So they are not consistent with the policy. If they are consistent, they are required to follow FIFO method in the opening year, in the comparative, in the transition date, in the comparative years, and also in the final year. So in our case, they are not following the consistent method. They are not following the consistent policies in every year, in all the periods. This change in accounting policy in the first time adoption of Ind AS is not allowed because they are not consistently following the accounting policies. In order to become consistent, they are used to follow whether the weighted average in all the 3 years or whether the FIFO. Suppose company follow SLM method for depreciation of property, plant, equipment before adaptation of Ind AS, but after adoption of Ind AS, company follow WDV method for depreciation of property, plant, equipment. Whether the entity follow guidance as per Ind AS 101. Entity follow the correct accounting policy as per the guidance available in Ind AS 101. No. Why? Because it is not an accounting policy. Firstly, it is an accounting estimate. So entity is not following consistent accounting policy because it is not an accounting policy. It is a change in estimate, and change in estimates is allowed. That is, if the company is following SLM before adaptation of Ind AS, but after adoption of Ind AS, company is following WDV, it is treated as a change in estimate and not as a change in accounting policy. So this change in the method of depreciation is allowed because it is treated as a change in accounting estimate and not treated as a change in accounting policy. If there is a change in accounting policy, then it is not allowed. But change in estimate is allowed as per the guidance available in Ind AS 101. Firstly, the accounting policy must be consistent. If it is not consistent, then they are not following the correct guidance. And latest version of accounting standard to be applied or used for preparation of financial statement as per Ind AS 101 for all the periods, as said by the Ind AS 101, that latest version of accounting standard is applied for preparation of financial statement. Suppose Ind AS 115, but there is some amendments on that standard, that is version 1 is there, that is on 1st April 2022. It's just this example is for giving a discussion only. It is not a fact. It is just for explanation purpose. It is not actual happen. There is a version 1 of Ind AS 115, that is on 1st April 2022, certain amendments. That is version 1 of Ind AS 115. On 31st March 2022, version 2 came, and there is a certain new amendments in Ind AS 115. And on 31st March 24, there is a version 3 came into exist, and with certain additional amendments. Now, when the company is applying Ind AS, then which version they will apply? They will apply version 1, version 2 or version 3. They will apply the version 3, latest version, in their Ind AS for preparing their financial statement. So in this case, Ind AS 115, version 3, that is the latest version, is used for all the periods. That is for opening balance sheet, for comparative balance sheet, and for finance balance sheet. So they are using the latest version in order to prepare their financials for all the 3 periods. Now there is some general principles for preparation of financial statement as per Ind AS. What are the principles? All assets and liabilities are recognized as per Ind AS. Means all the assets and liabilities are recognized as per Indian accounting standard. Some assets and liabilities are not required to be recognized as per previous GAAP, but need to be recognized as per Ind AS. Because in previous GAAP, some disclosures are not required. Derivative assets and liabilities are not required to be disclosed in the previous GAAP, but it is to be recognized in the Ind AS, because derivative assets and liabilities are not recognized in Indian GAAP. These standards are not available. These disclosures are not available. But these disclosures are available in Ind AS. So, some assets and liabilities are not recognized, which are not recognized in previous GAAP, but are required to be recognized as per Ind AS. For example, derivative assets and liabilities as per Ind AS 109, intangible assets as per Ind AS 38, fair value of previously held stock, which is not disclosed in the Indian GAAP, which is disclosed in Ind AS as per Ind AS 103. Non-current asset held for sale and discontinued operation. There is a so these which are not disclosed previously in the previous accounting standards are required to be disclosed in Ind AS. Then other principles are de-recognize all assets and liabilities which are not required. Means which are not required in Ind AS. These assets and liabilities are de-recognized. Some assets and liabilities are required, which are required as per previous GAAP, but not required as per Ind AS. Like for example, in case of revenue recognition, full revenue is recognized, which as per Indian Accounting Standard 9. But in Ind AS, deferred revenue is recognized as per the standard 115, as per Indian Accounting Standard 115. Because in Indian GAAP, there is Accounting Standard 9, which says that full revenue is recognized. But Ind AS 115 says that deferred revenue is recognized. So some assets and liabilities are recognized as per previous GAAP fully, but not as per Ind AS. Now, reclassification of assets and liabilities as per Ind AS. But in Ind AS, there is a classification is required under financial assets, financial liabilities. Previously in Indian GAAP, there is no sub classification of financial assets and financial liabilities. There is a current asset, current liability. But in India, there is a classification, proper classification is there. Like financial assets is there, financial liability, current financial asset, non-current financial assets. So current liabilities, non-current financial liabilities. So sub-classification is also required, like security deposits recognized under financial assets. Trade receivables are recognized under financial assets. Trade payables are recognized under financial liabilities. Whether they are current or non-current, it should be separated. Then measurements of all assets and liabilities as per Ind AS, whether measured at fair value, whether it measured at amortized cost, whether it measured at cost, like investment are measured at fair value. Financial assets and liabilities are measured at fair value. Security deposits are measured at amortized cost. So these are the measurements of assets and liabilities as per Ind AS. Classification is also important as per Ind AS. Now reconciliation from IGAAP to Ind AS in the balance sheet item. So like in balance sheet item, there is an Indian GAAP figure carrying value, then adjustment made as per Ind AS, then Ind AS actual final figure. Like in property, plant, equipment, IGAAP carrying value. Then whatever the adjustment is to be made, then the Ind AS figure is to be came. Investment in properties, intangible assets, capital WIP, inventories, trade receivables. Then equity and liabilities like equity share capital, other equity, borrowing, trade payables. All the figures related to IGAAP. Then whatever the adjustment made as per Ind AS, then actual final figure of Ind AS. In this way, the reconciliation formed by IGAAP to Ind AS is made in case of balance sheet items. We have to prepare a reconciliation from IGAAP to Ind AS for the first time in the balance sheet, because reconciliation is required to be disclosed if the entity prepares balance sheet for the first time by adopting Ind AS. So the balance sheets item is to be disclosed in the financials. Previously IGAAP figures, then adjustment as per Ind AS, then Ind AS final figure. Same way PL item is to be also reconciled from IGAAP to Ind AS, like revenue from operation, other incomes, total revenue, then expense, whatever the expense is, cost of material consumed, purchase of stock in trade, change in inventories, employees benefit, financial cost, depreciation, other expenses, then total. Whatever the IGAAP figures are there, any adjustments is there, then Ind AS final figure is to be reconciled, is required to be disclosed in the first balance sheet of as per Ind AS. Now notes. These gap adjustment needs to be computed as per application of different standard. All the adjustment needs to be explained in detail in financial statement. In these formats, opening and comparative balance sheets, equity reconciliation needs to be given. Optional exemption. Now we are going to discuss about the optional exemption. Optional exemption means it's depend on the management decision whether they will avail this exemption or not. It's an option based on the decision of the management whether they will avail this exemption or not. It totally depend on the management decision. So management will decide whether they avail the exemption or not. Assets and liabilities are measured at fair value on the transition date. Exemption क्या है? सपोज जैसे कि हम लोग ने इंडेक्स अप्लाई किया, इंडेक्स अप्लाई किया तो फाइनल बैलेंस शीट में इंडेक्स अप्लाई हुआ, कंपैरेटिव प्रीवियस ईयर में अप्लाई हुआ और ट्रांजिशन डेट दैट इज द ओपनिंग डेट. सो 3 इयर्स का बैलेंस शीट बनाना पड़ता है. तो ये जरूरी नहीं है कि हम लोग रेट्रोस्पेक्टिवली अगर अप्लाई करते हैं सारा स्टैंडर्ड एज पर दीज इंड AS 101 सेज दैट आप एप्लीकेशन करो सारे स्टैंडर्ड्स को रेट्रोस्पेक्टिवली. रेट्रोस्पेक्टिवली मतलब क्या होता है? जब अप्लाई कर रहे हो उसके पहले का सारा पीरियड पे आप अप्लाई करो, लेकिन ये पॉसिबल नहीं है बिकॉज इट्स वेरी टीडिशियस वर्क. बहुत ज्यादा काम हो जाएगा अगर आप एक बैलेंस शीट पे आप 20 साल तक उस पे आप एडजस्टमेंट करोगे. सो इट्स नॉट पॉसिबल. सो यहाँ पे एक सर्टेन पीरियड बता दिया गया. रेट्रोस्पेक्टिवली मींस कि आप ट्रांजिशन डेट से अप्लाई कीजिए, उसको ही रेट्रोस्पेक्टिव बोला गया. उससे पहले आपको कोई चेंजेस एडजस्टमेंट करने का दरकार नहीं. So, for example, all application of Ind AS is to be applied retrospectively, that is on transition date, not required to be adjusted before transition date. Transition date के पहले कोई adjustment का दरकार नहीं है. From transition date वहां से ही आप हम लोग मान लेंगे कि आपने अप्लाई किया Ind AS retrospectively. So यही exemption दिया गया है. ये मैनेजमेंट डिसाइड करेगा whether they will avail the exemption or not. All standards are applicable retrospectively subject to Ind AS 101. बिजनेस कॉम्बिनेशन क्या होता है पहले तो ये जानिए. एज पर Ind AS 103 बोलता है बिजनेस कॉम्बिनेशन मीन्स आप कंबाइन कर रहे हो बाय वे ऑफ मर्जर, एक्विजिशन, अमलगमेशन two business to get one business. So business combination needs to be applied retrospectively. Assets and liabilities acquire करते हो जो भी, recognize at fair value, purchase consideration at fair value, computation of goodwill compute कीजिए, capital reserve and deferred tax. ये business combination as per Ind AS 103 है. अब business combination का exemption क्या है as per Ind AS 101. 101 क्या बोलता है? exemption क्या दिया गया है? एक तो बोला है रीस्टेट, आप अपने पास्ट बिजनेस कॉम्बिनेशन को रीस्टेट कीजिए, और एक बोलता है कि आप डू नॉट रीस्टेट. अगर आप इफ यू डू नॉट रीस्टेट एनी पास्ट बिजनेस कॉम्बिनेशन तब क्या होता है? ऑल एसेट्स एंड लायबिलिटीज एक्वायर्ड इन पास्ट बिजनेस कॉम्बिनेशन शैल बी, जो भी आपने पास्ट में एसेट लायबिलिटी एक्वायर की है, शैल बी कैरी फॉरवर्ड टू Ind AS एज पर देयर कैरिंग वैल्यू. अगर आप अपने पास्ट बिजनेस कॉम्बिनेशन को रीस्टेट नहीं करना चाहते हो तो ये एग्जेम्पशन अवेलेबल है एज पर Ind AS 101. अगर आप फर्स्ट टाइम अडॉप्ट कर रहे हो, आपने बिजनेस कॉम्बिनेशन पास्ट में कर रखा है, उसको आप मतलब रीस्टेट नहीं करना चाहते हो, उसको एज इट इज कैरी फॉरवर्ड कर सकते हो. ऑल द एसेट्स एंड लायबिलिटी जो एक्वायर्ड की है आपने इन पास्ट बिजनेस कॉम्बिनेशन शैल बी कैरी फॉरवर्ड टू Ind AS एज पर देयर कैरिंग वैल्यू. ओनली अवेलेबल फॉर पास्ट बिजनेस कॉम्बिनेशन। अगर आप उसके बाद अगर मतलब इंडेस अप्लाई करने के बाद अगर कोई बिजनेस कॉम्बिनेशन एक्वायर करते हो तो उस पे ये एग्जेम्पशन अवेलेबल नहीं है, तब आपको रीस्टेट करना है। और रीस्टेट पास्ट बिजनेस कॉम्बिनेशन फ्रॉम एनी पर्टिकुलर डेट एज डिसाइडेड बाय द। एक तो आप रीस्टेट नहीं कर सकते, आपके पास ऑप्शन है कि आप रीस्टेट नहीं कर सकते और कैरिंग वैल्यू पे आप कैरी फॉरवर्ड कर सकते हो इंडेक्स पे। और ये सिर्फ अवेलेबल है ये एग्जेम्पशन टू बिजनेस कॉम्बिनेशन, पास्ट बिजनेस कॉम्बिनेशन। पर एक ऑप्शन और अवेलेबल है कि आप अगर रीस्टेट करना चाहते हो अपने पास्ट बिजनेस कॉम्बिनेशन को तो उसको रीस्टेट कर सकते हो from any particular date as decided by the management. Management has a choice to decide any particular date on which all past business combination needs to be restated. So management के पास choice है कि वो कोई particular date decide करे, वहां से वो सारा अपना past business combination को restate कर सकता है। And this exemption is also available only for the past business combination. Note: for any further business combination, Ind AS 103 needs to be applied. अगर Ind AS अप्लाई होने के बाद अगर कोई बिजनेस कॉम्बिनेशन होता है इन फ्यूचर तो वो फ्यूचर बिजनेस कॉम्बिनेशन पे Ind AS 103 लगता है, उस पे Ind AS 101 का एग्जेम्पशन अप्लाई नहीं होता है। अगर आप अपना बिजनेस को रीस्टेट कर रहे हो, अपने रीस्टेट बिजनेस एग्जेम्पशन अवेल कर रहे हो for the first time, if you are preparing your balance sheets, your financials, and you are availing the business combination exemption as per Ind AS 101 and want to restate the past business combination, so any adjustment made on that will be recognized in retained earning. But in case if intangible assets is there, is to be restated, it should be recognized and adjusted. Adjustment shall be made in goodwill. अगर intangible assets है तो उसका adjustment आप goodwill में करेंगे, और any other business combination का adjustment है तो उसका आप adjustment retain earning में। Now this concept of business combination is explained with the help of example 1. Suppose holding company has 3 subsidiaries S1, S2, S3. Holding company wants to restate past business combination in standalone financial statement as per Ind AS 101. In this case, exemption is allowed because holding company is a first time adopter. In case of first time adopter, any company holding subsidiary in its standalone financial statement allowed to restate their business combination. Whatever the exemption they want to avail, they can avail. They are allowed to avail any exemption. So in this case, holding company wants to restate, so they are free to do that. An exemption is allowed to the holding company because holding company is a first time adopter of Ind AS 101. Same way, subsidiary company S1 wants to restate its past business combination in its standalone financials as per Ind AS 101 because subsidiary 1 is also a first time adopter. These exemptions are allowed. Subsidiary 2 do not wants to restate business combination in its standalone as per Ind AS 101. So exemption is allowed because S2 is also a first time adopter. S3 wants to apply 103 retrospectively in its standalone financials as per 101. So because S3 is also first time adopter, exemption is allowed. Now, holding companies also in CFS want to restate its past business combination. As per Ind AS, it is also treated as first time adopter because an exemption is allowed. But these exemptions must be aligned in CFS. Subsidiary holding company individually in its standalone separate balance sheet apply different exemptions. But in CFS, they have to align all the adjustment, all the exemptions must be aligned in CFS, means whatever exemption adopted by holding company in CFS, subsidiary company needs to do appropriate adjustment entry in order to align with the exemption adopted by holding company in CFS. So subsidiary company are allowed or holding company are allowed to select any of the business combination exemption in its standalone financials, but in CFS, they needs to align with the adjustment in order to avail the exemption adopted by the holding company in CFS. So these exemption must be aligned in CFS, means whatever exemption adopted by holding company in CFS, subsidiary company needs to do appropriate adjustment entry in order to align with the exemption adopted by the holding company in CFS. In these cases, group company and legal entity is the first time adopter. Both the group company and also the holding company. Subsidiary company is a group companies and holding company is a legal entity. Both are first time adopter. A Limited has a subsidiary of B Limited. On the first time adaptation of Ind AS, A Limited by B Limited avail the optional exemption, not restating its past business combination in standalone financials. However, A Limited in consolidated finance has decided to restate its past business combination. Whatever the amount recorded by the subsidiaries needs to be adjusted in the consolidated books of A Limited, considering that A Limited does not avail the business combination exemption. So B Limited is a subsidiary of A Limited. B Limited avail optional exemption, that is not to restate the business combination in standalone financials. A Limited in its consolidated financial statement has decided to restate its past business combination. In standalone financial statement, it is allowed to take different exemption by the entity and a group. But in CFS, all adjustments of groups and entities must be aligned. Hence, in the above case, A Limited, who is first time adopter, can restate its past business combination. But appropriate adjustment needs to be made in order to align transition exemption in CFS. Now, insurance contract exemption. What do you mean by insurance contract? As per Ind AS 104, recognize all the assets and liabilities as per Ind AS 104 on transition date and not retrospectively. In this case, retrospective recognition is not required. Parallel standard of Ind AS 104 is not available in Indian GAAP, not existed in the Indian GAAP. This is explained. This concept of insurance contract exemption is explained with the help of example. A holding company is there and their subsidiary companies. Because subsidiary company is an insurance company who is exempted from preparation of Ind AS financials, but holding company prepares financials as by following Ind AS. Subsidiary company prepares financials by using Indian GAAP. Now, for consolidation purpose, whether the subsidiary company is required to prepare its financials as per Ind AS, yes, because for consolidation purpose, it is mandatory for the subsidiary company, even they are exempted from preparation of Ind AS. For consolidation purpose, they are required to prepare its financials as per Ind AS. So, but for consolidation purpose, subsidiary company needs to prepare its financials by following Ind AS. Even they are exempted from preparation of its financials as per Ind AS. But for consolidation purpose, they are required to prepare. Share-based payment, Ind AS 102. Share-based payment, apply Ind AS 102 principles retrospectively. All past ESOPs needs to be fair valued. Now, what are the ESOP exemption? Do not apply Ind AS 102 principles on those ESOPs which have been vested before transition date. Means exemption is available to those ESOPs who are vested before transition date. Apply Ind AS 102 retrospectively. Now these these exemptions explained with the help of example. Suppose total number of ESOP is 1000. Out of those 1000, 700 is vested ESOPs before transition, and remaining 300 are vested after transition date. So out of the 700, what it said, in these 700, management decided not to apply Ind AS 102 and avail ESOP exemption. These 700s are exempted from application of Ind AS 102 because they are vested before transition date, and remaining 300 which are not yet vested on transition date, application of Ind AS is mandatory. Application of Ind AS 102 is mandatory. Exemption is not allowed. Now, property, plant and equipment exemption as per Ind AS 10, as per Ind AS 16. Ind AS 16, what it says? Apply Ind AS 16 retrospectively. Component accounting is there. Cost of PPE to be computed as per Ind AS 16. Asset needs to be depreciated as per useful life. PPE exemption, there is an option to avail whether at fair value exemption or carrying value exemption. In fair value exemption, what are the exemptions available? Company may do fair value of any of the items in PPE and for balance apply Ind AS. Company is allowed in fair value exemption. Company is allowed to do any of its item in PPE. Items means we will explain what do you mean by items and what are the classes of PPE. Items means like there is a vehicle 1, 2, 3 like Maruti Desire, Honda City, Maruti Alto, Maruti. There are different varieties of cars. These are the items. But if there is a group of asset like class of asset like land, in land there are various lands like agricultural land, freehold lands. In building there are various buildings like office building, factory building, admin building. So building is a class of asset, but building 1, building 2, building 3 are the items of assets. So these are the differences of between the classes and items. Company may do the fair value of any of the items in PPE, and for balance asset they apply Ind AS. Pick and choose of items is available means allowed. You can pick any of the asset and you can fair value that asset. You are allowed to do fair valuation on any of the assets. So pick and choose of items is allowed in these exemption as per Ind AS 101 or PP exemption. Past year revaluation can be taken into consideration if any revaluation done in past for that asset is to be taken into consideration provided it is broadly comparative with the fair value on the transition date. Any other adjustment arising from other standards like impairment, if any impairment is there, like if any government grant is there, like if any loan is there from borrowing cost, any other standard, any adjustment is there, shall be adjusted in retained earning. So these are the fair value exemption. Exemption is available. You can do the fair value of any of the items. It is not necessary to do the fair valuation of all the items in the class of assets. But in carrying value exemption, what are the carrying value exemption? If carrying value exemption is taken, in case if the entity avail the carrying value exemption, then it will be applied for all the items. In case of carrying value exemption, you have to value. This exemption is applied to all the items and classes of PP. It is not pick and choose of the items is not available in these exemption. In carrying value is not allowed. Carrying value means gross block, less accumulated depreciation, less impairment loss, then net carrying value. Net carrying value means it is also be treated as a deemed cost and depreciated over the remaining useful life. Net carrying value will be also be treated. It is also called as deemed cost and depreciated over the useful life. Impairment loss recognized in the past shall not be reversed in future. Any consequential exemption shall be made arising out of other standards like impairment loss, like government grant, like processing fees in case of borrowings. So any adjustments is there, then that should be made arising out of any consequential adjustments shall be made arising out of other standards shall be adjusted. So these are the fair value exemption and carrying value exemption which we had discussed. Concept of the classes of assets. What are the concept? Classes of assets किसको बोलते हैं? Class of asset means land itself is a class of asset, building is a class of asset, vehicle is a class of asset, computer is class of asset, office equipment is a class of asset. Land, on land there are items. The land in Gurgaon, land in Punjab, land in US. These are the items available in the class of assets. Like building, office building, factory building, admin building. These are the items. Building in Punjab, building in Maharashtra. Computer, Dell laptop, Apple laptop. Dell computer is a class of assets. Dell laptop is an item on that class of assets. Vehicle is a class of vehicle. The word vehicle is a class of asset. But Maruti Desire, Maruti Season, Maruti Suzuki, items, that is one items are, these are the examples of items. If they are following the carrying value approach, in carrying value exemption, you have to only allow to do the carrying value method is applied. But in a fair value exemption, you can apply in some of the items carrying value approach and in some of the items fair value approach. So in fair value exemption, the pick and choose option is available. You can apply, like in land in Punjab, you can apply fair value method exemption for single item, and for others you can apply Ind AS 60 or carrying value approach. But in carrying value exemption, you have to apply carrying value approach in all the items. Pick and choose option is not available. Now this concept is explained with the help of example. Suppose holding company is there. There are three subsidiaries, S1, S2, S3. Holding company adopt carrying value in its standalone financial statement, and this exemption is available to the first time adopter. They can adopt any value, any approach, any exemption they can avail. Subsidiary S1 will adopt fair value exemption in its standalone. They are free to apply because they are this exemption is available to the first time adopter. And if they are preparing their financials as per Ind AS for the first time, they are allowed to do. Subsidiary 2 wants to apply a carrying value approach, they are free to do in its standalone financials because they are adapting for the first time. Subsidiary 3 also can apply Ind AS 16 in its standalone, and they are free to apply because they are the first time adapter. But in consolidated financial statement, company needs to do an appropriate adjustment entry in order to align with the transition exemption adopted by holding company in its CFS. Group companies in its individual financials are applying different exemptions in their, they are allowed to do different exemptions. They choose to allow to do different exemptions. Like some subsidiaries are adopting fair value approach, some subsidiaries are adopting carrying value approach, holding companies are adopting another approach. So they are free to take any exemption. But in consolidated financial statement, they are appropriate adjustment entry in order to align with the transition exemption adopted by holding company in CFS. In these case, group company and legal entity is also first time adopter. In standalone financial statement, different entity can take different exemption, but in CFS, appropriate adjustment entry needs to be made in order to align with the transition exemption. Now allocation, component accounting. We are discussing about the component accounting, how to allocate cost on the basis of fair value. So guidance is available in Ind AS 16. Suppose there is a company who is a manufacturing unit, manufacturing of Tesla car, whose carrying value of the car is 90 crores and the fair value is 120 crores. Now there is a component component, the fair value of component is given, like cost of tire is 10 crores, cost of body of the car is 25 crores, cost of other parts used in the car is 10 crores and cost of engine is 75 crores. Total fair value is 120 crores. Now allocate cost. Cost is given, that is 90 crore on the basis of fair value. Fair value is given 120 crore. Now solution component fair value carrying value on the basis of fair value. Cost of tire is 10 crores. So 10 crore divided by 120 crore into the carrying value of the car is 90 crores. So individuals ka carrying value on the basis allocation of carrying value on the basis of fair value is 7.5 crore. In the same way, cost of body is 25 crore. Cost of body, that is the fair value. Fair value is 25 crores. So 25 divided by 120 into 90, that is 18.75. Now other parts used in the car, that is 10 crore. Fair value of that is 10 crores. So 10 divided by 120 into 90, that is 7.5 crores. Engine ka cost 75 crore. Fair value is 75 crores. Carrying value is 90 crores of whole. And total fair value is 120 crores. So 75 divided by 120 into 90, that is 56.25 crore. Total 90. Yes, component cost can be allocated based on fair value. It is allowed to allocate the cost on the basis of fair value. Now revaluation previous gap. Past revaluation can be considered as fair value on transition date, provided it is broadly comparable to the fair value on the transition date. Period of past revaluation is not defined in the standard. Management needs to apply their judgment. Now cumulative transition differences as per Ind AS 21. Guidance under Ind AS 21, what it says, if there is a foreign subsidiary, associate, joint venture needs to be converted from their local currency to functional currency. For example, monetary items are there, converted at closing rate. Non-monetary items are converted at historical rate. PL items are converted at average rate. And the difference will be recognized at FCTR, that is Foreign Currency Translation Reserve in OCI. Now exemption, cumulative translation difference का exemption क्या, FCTR का exemption क्या available है? Transfer all balances of FCTR to retain earning on transition date. If the previous balances is there, it should be transferred to the retain earning on transition date. This is an optional exemption. Like journal entry will be FCTR account debit to retain earning. Thanking you for watching my video. If you like, please share, subscribe my channel.